Welcome, everybody, to the NYPAY Paying Less to Get Paid session. I'd like to start by thanking NYPAY for the opportunity to moderate the session. I'd also like to thank Interpayments for their sponsorship of this session. And of course, I'd like to thank the panelists for their participation. My name is Dean Schaefer. I'm your moderator. I have over 30 years experience in payments, both on the issuing and merchant sides, and I now provide payments consulting services through my Team Paytech business. Today, we'll be discussing three specific levers that can be used to steer payments. The first is surcharging, a practice that is becoming more common and will have fewer restrictions should the Visa MasterCard settlement become final. The second is buying groups that will allow groups of merchants to negotiate their payments cost. Also, this will be enabled by the proposed Visa MasterCard settlement. The third is Pay by Bank 2.0, a unique value proposition for merchants and consumers. We'll start with some introductions and then focus on each of the three topics. Feel free to ask questions during the panel discussion. I'm hoping the session will be super interactive. At the end of the panel discussion, NYPAY will facilitate a breakout sessions for those who want to do a deeper dive into any of the topics. NJ, Lou, and then Matt, thanks again for being here. Would you briefly introduce yourselves?
Well, first, I wanted to apologize for getting here late. This is David True, the president of NYPAY. Dean is a Swiss origin, and we're fortunate he didn't bring a cowbell to this. But I want to thank all the participants. This is a great topic, and I really, really appreciate everyone joining, and I look forward to the debate.
Thanks, David. So NJ, Lou, and then Matt.
Great.
Let's hear about you guys.
Thanks for having me on today. My name is Nagendra Jayanti. You can call me NJ. I'm the CEO of Interpayments, and we are a managed surcharge provider serving six of the top 10 acquirers in the country.
Hi, everybody. Thank you, NYPAY, Dave, Dean. My name's Lou Morchberger. I'm the founder and CEO of Payment Strategy Consulting, LLC. We help merchants and trade associations navigate the increasingly complex world of payments, especially with an idea to lowering payments acceptance costs.
Yeah, hi, I'm Matt Brennan, President and Chief Commercial Officer of Pay with Spire. We go by Spire. We are a pay-by-bank provider. It's a payment tender we offer to merchants who then offer it to consumers. And really happy to be here.
Great. Thank you all again for your participation and those great intros. Let's kick it off with surcharging. NJ, what is credit card surcharging and what problem is it trying to solve?
Yeah, great question. And it's actually a little more nuanced than most people think it is. So, credit card surcharging is the collection of a fee from a customer when they pay using a credit card. And that fee is the cost that the merchant would have to accept that particular card. It's a very specific definition because it only applies to the specific challenge in a targeted manner of credit card fees. There are other forms of fee recovery. So people talk about convenience fees, service fees, and many people don't know, but those are legally distinct terms. They apply to different forms of fee recovery around processing costs, but surcharging is specifically oriented around credit card fees. The reason people are increasingly adopting surcharging, JD Power put out a survey earlier this year that shows about a third of all SMB merchants in the US are surcharging in some way today. And the reason they're doing that is because credit cards are the highest cost payment method out there, as many know. And I guess, many people feel like they're eating into their margins in a bigger way, especially as merchants are accepting more cards because they're accepting more digital payments and cards just become a bigger share. And so millions of merchants in the US, Canada, and a few other countries are looking to take control over these costs, but they don't necessarily want to raise prices on all of their customers just for the ones who are paying by the highest cost method. And so surcharging is a kind of selective way to help them manage those costs around that. I think what we're seeing is that many merchants know this and they're increasingly looking towards their partners, the acquirers, ISV platforms, things like that, to provide them a solution. So that's ultimately the problem that they're trying to solve around surcharging.
Great, great, great. So like anything in payments, right? There has to be complexities to this process. I've rarely run into any topic in payments where it hasn't been nuanced and complex. But talk a little bit about what the challenges are and why it's important to stay compliant.
Yeah, I think the complexities go around compliance as well as just how does it affect your customer base. Let me just first start off with the customer base because I think this is a question that comes up, and I think David just posted something.
Mhm.
Um, so surcharging is not for everybody. Just full stop. It is not a good
Mhm.
practice for everybody to use. However, it works very well in particular situations and industries. So I'll say that most of our customers, and these include Fortune 500 publicly traded companies, um, are using surcharging as a tool to recover costs around invoice-based payments. And this could be from B2C transactions to B2B transactions. And the reason surcharges work really well there is because you've already delivered the service or the product, and no one is going to be upset by having an added fee after the product or service is delivered because you're also offering other forms of payment, whether it's check, ACH, pay by bank that we're going to talk about today. If you offer a lot of choices and you're adding a fee to one of them, that's the best practice. And that is typically where surcharging works really well. It does not work well in an e-commerce based transaction like online, where someone isn't really well aware of what the fee is going to be. They're looking to buy a commodity product and they'll just leave your site to go to another site to buy the same product. It also works well in retail card present situations. So we see a lot of SMB merchants on Main Street, type restaurants, things like that, that are surcharging in a big way, and it's because there is an alternative form of payment method, whether it's cash or again, pay by bank or the or pulling out your debit card, other things that you can do to avoid the fee. So that's the first part of the complexity that people have to get over. But again, it's more and more use cases around invoice type based payments. Um, but if you are going to surcharge, there's a lot of complexities around compliance.
Mhm.
So a fee has to be collected in a very specific way, and those rules span card network rules. So each card network has its own rules. Each state and province in Canada and territory has its own rules. And then specific industries can have their own rules. So you think about insurance as an example, heavily regulated
Mhm.
industry. Each of the departments of insurance in each of the states has its own rules. So you've got to be managing all of those jurisdictions rules before you surcharge. There are a myriad of court rulings and precedents that have been set there that you have to keep in touch with, and all of these rules can come into conflict with one another, but they have to be resolved before the authorization of the payment. So it has to
Mhm.
happen before the customer hits buy now. And so that is why it becomes really complicated. The surcharge also is not just in the percentage fee that is shown. That we call that the tip of the iceberg. The fee that's shown to the customer is just tip of the iceberg. What you have below that is all the compliance layers we just talked about that drive what that fee can be, but also you have business considerations. So when we talked about how is it going to affect my customers, how am I talking about payment with my customers? What am I going to be? How competitive am I in the market if I'm offering a surcharge offering and others are, may not be? And then the third complexity is around the technical implementation of this. So more and more merchants are accepting payments within software platforms or through other technology products. Those technology products have to be set up to run the whole life cycle of surcharging, which is I've got to disclose the fee properly so it's never a surprise. I then have to make sure it's the correct amount of the fee based on all the different rules that are out there and maybe even the products or business lines that I have. And then finally, once I've accepted that payment, I have this brand new line item in my general ledger that I've never had before. and I have to account for that appropriately for sales tax or refunds and other things that I need to do for my reporting on a GAAP basis. So surcharging is a program. It is not a feature. It is not just a fee that you're adding to the cardholder, but it's all these things I just talked about wrapped into one. There's a business transformation, and what you want to do is try to find a provider who's going to automate as much of that as possible for you out of the box. So those are the big
That's great.
complexities that come out.
Thanks. I would add to that, I may have missed it, but also Visa, MasterCard operating rules and regulations are in play along with all of those other compliance elements you mentioned.
Yeah.
David had a good question. What percentage of current surcharging do you think is non-compliant?
We believe that we're the only fully compliant solution in the market. We also indemnify against any risks. I'm not trying to plug our solution. I just am telling people that that's what you
Yep.
should be thinking about when you're going out to find a service. And I think that 90+% of the market is doing non-compliant surcharging. And
Wow.
you think about compliance. Compliance spans card network rules, state rules, and potentially even industry rules. It also includes things like,
Mhm.
are you accounting for it properly for GAAP tax purposes, sales tax? So
Yep.
I would say that most people are not doing all of those things, which makes it non-compliant. And we believe here at Interpayments, and our partners do too, that partial compliance is non-compliance. Um,
Agreed.
there's one last thing that I failed to mention, which was the risks around the complexity of surcharging. So, um, there are people out there willing to take risk, and to each their own. People should be aware of what the risks are. So first, you have the card networks, and if you think about Visa and Mastercard, their fines start at $1,000 per infraction, and they rise to $25,000 per infraction. An infraction could be based on what we've seen in the past, but determined by them to be every transaction that has an improper
Mhm.
surcharge. So those fines can rack up, and some of our partners have racked up seven-figure fines around surcharging.
Wow.
Um, so that's one. The second risk is around state attorney general risk. So,
Mhm.
that requires you getting a lawyer involved. There's discovery. There's a whole thing that happens around a state getting involved in your surcharging
Mhm.
practices. And so, that's a risk you should take. That also creates reputational risk for your business if you don't do that properly. That's why some
Mhm.
of our customers have come to us. You also have class action lawsuit risk. So,
Mhm.
we've heard and seen other customers saying that, hey, I was surcharged non-compliantly, law firms getting a hold of that and then trying to,
Right.
create class action around improper surcharging. So those are the risks that come out of the
Mhm.
complexities that arise from in
Yep.
surcharging.
Yep. So, and NJ, I'm going to ask Lou as he begins his part of this to give us a brief recap of the settlement. And obviously, there are elements of surcharging that are part of the proposed Visa MasterCard settlement. So, if you can help us answer any questions regarding that, that would be greatly appreciated. But earlier on, you mentioned some other fee recovery options. So, service fees, convenience fees, cash discounts, whatever. Why surcharging instead of those?
Surcharging targets just credit card fees, which is the higher cost fees. If you're going to do
Hmm.
a service fee or convenience fee, they apply to kind of all payment methods out there. So it's a
Hmm.
question of, do you want to apply fees to all your payment methods or just to the highest cost payment method? A convenience fee refers to a flat dollar amount, which cannot vary by the amount of the transaction,
Hmm.
um, that is used in an alternative payment channel that you have. And it has to be a card not present payment channel. So think about the traditional example of a movie theater. So you can
Hmm.
go to the movie theater and buy a ticket in person. That would be the primary payment channel. But there is a convenience to buying those tickets in advance online.
Hmm.
A set dollar fee can be applied to those payments. And that's typically what you see. So that's a convenience fee. Now, the challenge with convenience fees that many merchants have is that because it's a flat dollar amount, if your average order value varies a lot, the convenience fee doesn't cover recouping your cost of accepting cards or in other forms. So if you have a $5 transaction with a $5 convenience fee, you're basically like doubling the amount they pay. But if you have a $500 order value, that doesn't really recover the
Right.
cost that you would have had on that. So that's the
It's
that's
not
the convenience.
proportional to the
That's
transaction.
right.
Yeah.
And then
Yeah.
a service fee only is allowed by certain MCC codes that are government and education MCC codes.
Mhm.
It allows you to kind of set the fee wherever you want. It's supposed to be related to your cost of payments, but it can apply to anything. So you typically see this on you paying your property taxes or court fees or income
Yep.
taxes. You see a fee applied, and that is a service fee. But
Right.
surcharging is one of the most flexible out of them because they can be used by anybody and it can be applied to any payment channel within any industry vertical. And it only
Yeah.
targets one form of payment method.
I think we've sort of covered the next topic, but I'll ask it anyway to see if there's anything you have to add. How do customers usually react when they see surcharges on their transactions, in 2026? It's, I think, pretty pervasive now, and I think most consumers get it, but you're way closer to it than I am.
Yeah. Yeah, when we started doing this after the U.S. Supreme Court legalized surcharging in the U.S. back in 2018, there wasn't much surcharging going on then, but we thought there might be, and I would say that it was viewed very negatively back then.
Hmm.
You fast forward to 2026, and there are 13 states that are putting out rules around surcharging. That's just an
Hmm.
indication of the level of adoption of surcharging, and that states are saying this is rising to a place where we need to be setting laws in place to make sure it's being done
Hmm.
appropriately. So a lot more is happening. And then I cited that JD Power survey that
Sure.
codifies that a lot of people are doing it. Um, so I think that consumers are expecting it more. However, I would tell you that there are because most of it's non-compliant, it's not done in a way that's great for the customer, and it's
Hmm.
not good for the card industry in total, in payments industry in general. Because if a customer is surprised by a fee, that's a bad experience for the customer, and then it makes that payment experience
Yeah.
just not a great one. And so the thing that the rules are trying to get to, and that we recommend everybody does, is make sure there's great, adequate disclosure early and often. And that, in our view, begins even before you implement a surcharging program, and that's what we help merchants do. But also in advance of when the payment's going to happen. Just make sure that's
Yeah.
clear to them, and then make sure it's clear to them after the fact. The rules kind of require that, but you got to make sure that's being done. And when you do those, and you offer an alternative payment method, so that it
Mhm.
doesn't feel like a penalty. Most of our customer, all of our customers, sorry, all of our customers have found that when they introduce a surcharging program, it becomes customer choice, right?
Yep.
I'm disclosing it early and often. They know that they have an alternative payment method. And if they choose to go with the surcharge, it's been their choice. And
Yep.
no one's lost customers. They might shift payment method. We do see a shift in payment method, but
Hmm.
but becomes a very viable solution for many merchants. And again, in particular payment types, primarily invoice-based payments is where it works really well.
Great.
And then you don't have any
Thanks.
issues.
Yeah. Last question before we move on to Lou, which is, if I'm a merchant and I'm thinking about surcharging, what words of wisdom do you have? What questions should I be asking of potential providers?
Yeah, I think the way you should look at it is merchants are becoming more educated on this. Customers are becoming more educated on this. You can just go to Reddit and see all the posts on
Hmm.
non-compliant fees being applied. And so I would ask yourself a couple of questions. One of them is how important is compliance to you? And are
Hmm.
you aware of all the different compliance regulations that you need to be handling? How am I being protected against those? Like, how am I making sure it's being done properly? And that goes to the risk posture and how important indemnification is based on your risk tolerance. The next big one is how am I going to implement this? Like, does this work with my current payment technology providers and my current payment service providers? Um,
Hmm.
Do I have to switch? Hopefully you don't have to. That makes it easier. The next one is what services are offered beyond the technical implementation. Things that matter a lot when it comes to customer acceptance and the overall return on investment. And I also think that people should be looking at customizing surcharging. It's not really a one size fits all from our experience. Merchants like to customize where they're applying surcharges. So in this business line, only in invoice-based payments, not in one-time payments, for example, or maybe in just recurring payments and not others. I think you want to think about it as where am I having the biggest pain points around these fees, and
Mhm.
how can I customize it and make sure that it's working for my customers and the business lines that I'm working with. So those would be the big
Yes.
questions to ask.
Awesome. Thank you, NJ. Super, super great insights. We'll loop back for questions at the end. And again, for participants, if you have questions for the panelists as we move along, please do ask them. We're happy to answer them. But Lou, moving on to you, can you give us a short summary of the proposed Visa MasterCard settlement, and then we'll jump into buying groups.
Sure, no, glad to. The proposed settlement will increase complexity as merchants figure things out. And there are an awful lot of details to it, but I would just highlight a couple of the proposed changes it would entail. Number one is that it very much relaxes a lot of the honor all cards rules that Visa and MasterCard have had in place for more than 40 years. So whereas today, if you accept if you accept one Visa card, you have to accept all Visa cards. Likewise, MasterCard. And to some extent, how you treat Visa and MasterCard is even tied to how you treat Amex and Discover. And that's just been a core objection of the merchants who've been pursuing the litigation against Visa and MasterCard. The proposed settlement would relax those rules, and it would allow merchants to treat Visa different from MasterCard, different from American Express and Discover. And it would also allow merchants to treat different types of Visa differently, different types of MasterCard differently. So you can, for the sake of whether a merchant chooses to accept cards or surcharge cards, and that touches on what NJ is very familiar with, the settlement would allow merchants to surcharge or choose to accept or decline based on brand, that's Visa or MasterCard, based on product type. This is a new thing where they're now designating a standard type of credit card, a premium type of credit card. That's the more expensive ones from an interchange point of view, presumably with rewards. Also, a commercial type of credit card, including small business. And then there's the long-standing, just credit versus debit. So merchants could surcharge based on the product type. They could surcharge on the specific product. That's Visa's signature. You could surcharge on the basis of Visa's signature, but not surcharge Visa traditional rewards. Or similarly, MasterCard World versus MasterCard World Elite. What you can't do under the proposed settlement is discriminate on the basis of the issuer. So if you accept a type of Visa card, you have to accept the Chase version of that, same as you'd accept the Capital One version, same as the Wells Fargo. That part doesn't change, except that you could offer discounts for issuer specific cards. And that becomes, if you envision that merchants could negotiate directly with different issuers, the issuer could propose, hey, give a discount to your consumers when they present my card, and we'll give you a price break. So the relief of the honor all cards rules is probably the most important part of the settlement. It's paralleled by a relief of the honor all wallets rules. And I won't go into a lot of detail there, but effectively merchants can begin to pick and choose which digital wallets they will honor, though they have to respect the same card rules in the digital wallets as they would respect at point of sale. Shifting, and there's a lot of other rules changes, but they're the most impactful ones. Shifting to the rate impact of the settlement, there's really two highlights on the rate impact. Number one is that newly designated standard category of credit card will be capped at a 125 basis point rate interchange for an 8-year period. So, of course, the average interchange rate system-wide for Visa and MasterCard last year was 236 basis points. And probably only a small portion of that was the traditional credit cards. But under the proposed settlement, that category would be capped at 125 basis points, way below where it would be today. And the objective there is to give merchants a reason to incentivize the use of those credit cards and thereby work their interchange rates down. Second piece of the rate relief is that Visa and MasterCard are committed to an average 10 basis point reduction in rates for a 5-year period. There's a lot of arithmetic and strategy that goes behind, well, gee, how do they actually get to that 10 basis points? We won't know that probably for another, till sometime next year. Merchants would say the settlement is very imperfect. I think everyone would agree it's imperfect. And there's a lot that merchants wish would be better. On the question of, gee, is 10 basis points significant or not? Remember that the objective of the settlement is to enhance competitiveness between Visa, MasterCard, and the other networks. There was a separate settlement that covered cash payouts based on historic processing with the network. So as we look at the economic value of this settlement, it's important to keep in mind that Visa and MasterCard and the banks are already paying $5.5 billion for past wrongs. They wouldn't call it wrongs, but that's how some merchants would probably describe it. But so I'll stop there. Those are the key points of the settlement. Happy to answer additional questions, but suffice it to say, these rule changes do promise to enhance competitiveness, but they also promise to create some confusion when they're first rolled out, if they're rolled out, because the settlement still has some major milestones to go through. The final approval hearing is scheduled for November 16th. If the judge approves it, he'll probably issue an opinion in December or January. If that approval is part of that decision, then there'd be this flurry of activity whereby the networks are implementing the rules, merchants are ramping up for what they should be doing with them, and so forth.
Mm-hmm. Great.
Exciting times ahead.
It is. It's exciting, confusing, and I think the key point is, let's make sure that we're all watching how the settlement evolves over time. To your point, presumably it will be approved, but I imagine there's going to be an immediate appeal, and we have to figure out what the effect of that appeal may or may not be.
And if there's an appeal, then it's kind of, lawyers would differ. Would the settlement go into effect while the appeal is pending, or would it be stayed? A lot of legal strategizing around that question.
Yeah. Right. So let's move on to buying groups. So what the heck are merchant buying groups, and how do they work?
Yeah, no, for sure. As the name implies, a merchant buying group is a group of merchants that come together to negotiate with any vendor, but in this case, in particular, with the card networks, looking for preferred terms on interchange. And we know buying groups from other verticals, other industries. Sometimes they're referred to as group purchasing organizations. They're especially highly used in healthcare. Healthcare is probably where they've gotten the biggest momentum over more than 50 years now. But they're also used in hospitality. They're also used in grocery. Plenty of industries have group purchasing organizations. Historically, they haven't been used in the payment space. And I'd attribute that to a combination of Visa, MasterCard, and the networks have generally not been inclined to negotiate with buying groups. Secondly, it's very complicated to track all these rates and figure out how a buying group should be charging fees. And then thirdly, I would say is just that the merchants haven't had a lot of leverage. They haven't had a lot of alternatives. So if Visa, MasterCard, or Amex or Discover say, we're just not going to talk to you, merchants haven't had a lot of places to go. I think those things are changing now.
Gotcha. Thanks. So obviously buying groups, broadly speaking, are not a new thing, but are they new to the payments world? Have they been done before in payments?
A little bit primarily focused on processors. And
Hmm.
as probably a lot of us on this call can appreciate, the lion's share of card acceptance fees is interchange. That's probably 70 to 75% of the total of acceptance fees. The processor's getting maybe 20%, and then the networks, Visa, MasterCard, and the others might be charging 5% just for their fees along the way. So the lion's share is with the networks. And yet, historically, in the payment space, when people have tried to negotiate, they've been pushing on the processor, which is where only 20% of the value lies.
Hmm.
So when it comes to Visa, MasterCard, we can all imagine that, hey, folks like Walmart and Amazon, maybe some of the airlines, they get preferred rates, but very few merchants beyond that get a better rate from the networks, and that's what buying groups would propose to change.
Gotcha, gotcha. And we mentioned, obviously the Visa Mastercard antitrust proposed settlement.
Yeah.
How does that specifically affect buying groups and their
Yeah.
abilities?
Um, uh, in the settlement proposal announced in March of 2024,
Hmm.
which did not get approved by the court. But that settlement made a pretty big deal out of merchant buying groups as a way to enhance competition among the networks. Um, when that settlement, the March 2024 proposal, didn't get approved, now fast forward to November 2025, the most recent and pending settlement proposal, buying groups were also included in that proposal, and probably with even more prominence, in that this settlement includes a $21 million merchant education program to educate merchants, of course, about how these new rules affect them, how they can take advantage of them. And that merchant education program would include a fair amount of discussion, as specified in the settlement proposal, a fair amount of discussion of buying groups. Even if the settlement weren't to be approved, or if it gets tied up in court, I believe, and I think there's folks who would agree with me, buying groups are here to stay. They're going to happen regardless of what happens with the settlement, because those issues of Visa, MasterCard, and transigence, complexity, and just merchant leverage, I think, are all changing in favor of the merchants. I should add that the settlement proposal requires Visa and MasterCard to negotiate in good faith with buying groups, which certainly is an additional tailwind for buying groups.
For sure, for sure. So last two questions before we move on to Matt and Pay by Bank, but they're all kind of interrelated anyway. So how do you see buying groups affecting interchange and payment steering generally going forward?
Yeah, no, a great question. And I think that's why it's neat that the three of us are on this panel at the same time, because I think, from the buying group perspective, and talking about leverage in negotiations with the networks, that leverage is enhanced when merchants have alternatives that they can move customers toward. So if in the case of interpayments and surcharging, if a merchant feels confident that, gee, if I surcharge some portion of my customers, that will motivate Visa and MasterCard to start negotiating even better deals with me as a really big merchant, or with me as a member of a buying group. Likewise, Pay by Bank, such as with Spire that Matt's going to tell us about, that's another alternative payment method that a merchant can shift their consumers toward. And it's probably a misconception that to have leverage with the networks, you've got to be able to threaten to like cut off half the business you're sending their way. I don't think that's the case at all. In my history in the payments industry, I've negotiated more than $1 trillion worth of volume with the networks, and I know that if you can convincingly tell them that you're going to move 2% of the volume, you'll have their attention. And so, I think that's where Pay by Bank and surcharging are very complementary tools, along with buying groups, to help merchants have more options.
Yep. That's great. Lou, super insightful. Thank you very much. Matt, we're going to move on to you and we're going to talk about Pay by Bank 2.0. So what's the why now for Pay by Bank 2.0 in the US and what's changed in the last 12 to 24 months to make this sort of real at scale and adoptable for merchants and consumers?
Well, to start with, thanks for leaving the best till last, Dean. I appreciate that.
Pleasure.
Yeah. Well, it is actually a great time for Pay by Bank. And it's not just one thing. I think you kind of framed it. The why now is actually multiple things. And when that happens, I think you always get a tailwind. And when you're trying to bring alternate payment types into the marketplace, it's been around for a long time. Let's be honest. Pay by Bank has been around for probably over 13, maybe 14 years. It all started with MCX, and that group of merchants got together and said, there's got to be a better way, right? Well, they had the right thought. They just were before their time. And that's really what's happened in the last 24 months. I think we've got to the right time. So what are those things? Primarily, I think open banking in general has now become a way that a lot of consumers have already made a payment of some type. And that just 2 years ago, that wasn't the case. I think we're now in excess of 300 million bank accounts have been linked to make at least one transaction. And if you've just, have a Venmo account or a PayPal account, you've probably already established a pay by bank credential. If you've paid your electricity bill, maybe you've paid your taxes, maybe you've paid for your driver's license to be updated. There's always been options to actually do an ACH transaction, and you've probably used, open banking to transfer those credentials. So that's been a big thing. The consumer is more open, more willing, and the technology to actually link a bank account for those types of payments has improved dramatically from a consumer experience standpoint, from a security standpoint. So there's a comfort level now that has surpassed, anything that we thought that was even possible probably just 2 to 3 years ago. And so the plaids of the world have really made an incredible improvement there. So that's one thing. And then we've made some significant changes as a company, and that's been around acceptance of payments, especially at the point of sale. And I think that's been where there's been a gap for the consumer. They haven't been able to use Pay by Bank, I think, in a traditional way for them, in a way that they've already learned how to make a payment at the point of sale. And we've been able to change that with the ability to accept payments at points of sale, with a terminal exchange. We can talk a little bit about that, I think, as we progress. And then the third thing, and I think this is not to be underestimated, is technology in general has just improved the ways in which this payment tender has actually been made available to that consumer. And the merchant now is far more interested in taking on those different types of technologies from loyalty. The apps have got better, stacking rewards has got, but there's been so many advancements in just technology in general, and that has lifted all the boats up, and including in that has been Pay by Bank.
Great. So let's back up a little bit or go up to the 30,000 foot level just a little bit. So for people that are not particularly familiar with Pay by Bank, what problem is it trying to solve for the merchants and for the consumers?
Well, primarily for the merchant, it's always been a way to actually reduce processing fees. And so that's really what it was anchored in right from the start. It continues to be one of the best business cases for it. There is no interchange. Now, we've made some improvements to it, which have actually changed the dynamics a little bit. But that's really what's been originally the mission. Now, what's evolved over time for the merchant is that they've also put their brand on it, and now they've made it a branded payment type, and they introduced loyalty to the customer through that brand association and adding another payment that actually drives the consumer to use not only the payment tender, but to come back more regularly because of the reward relationship, the loyalty relationship, and maybe even spend more money. A great example of a success story is the Target Red Card. So the Target Red Card, the most predominant way people actually pay with the Target Red Card is ACH debit. So it's pay by bank. And what's happened in that whole business case is that people, by getting a reward, an additional reward, they've gone back to Target more regularly and they've spent more money on each transaction. And that's really where the merchant has had a really draw card to the payment tender. So what about the consumer? Well, the consumer, by actually adopting this payment type, is getting incented by the merchant directly from the merchant. You know, it's not like I'm getting my MX points and I'm going to Mexico. Even though the merchant paid for those points and is paid for the Mexico trip, the consumer is getting it directly from the merchant at the moment they're making the transaction. They're getting 10 to 15 to 25 cents off a gallon. They're getting 2% for making a purchase in a grocery store, right? They're getting one extra coffee off a week for actually buying a coffee, all around this choice of payment tender. So the merchant now has the unit economics to provide loyalty, provide extra rewards, and the consumer loves getting those extra rewards directly from the merchant.
So I've got a question in the chat. Have you seen examples other than Target offering incentives or other discounts to consumers to use pay by bank?
Yes, absolutely. Within our portfolio of merchants, we have about 75% of branded fuel. So if you go to a Chevron, an Exxon, a Valero, I could go on, right? But branded fuel, you're going to be offered from 15 to 25 cents off a gallon. And this is not just for the first transaction, all transactions, if you use their branded pay by bank, product. So if you go to an Exxon, for example, if you use Direct Debit Plus, that's actually powered by Spire, you're going to get ongoing stackable rewards from Exxon for using that payment tender. You might be able to bring rewards in from your grocery store and stack another 12 cents off for pay by bank. And then they might even give you, for using their loyalty program, another 10 cents off. You could potentially stack 25, 35 cents off a gallon. And that's all based around the pay by bank. It's in the convenience store space. Another example would be Quick Trip, QT Pay, fabulous program, offering always big rewards. The category where we participate, so the examples I could give are all around everyday spend. So it's all the everyday spend categories. It's grocery, it's gas, it's convenience, it's coffee, these things we buy every day. And they're all offering a reward or an incentive to use the payment tender.
So that's why I think I've heard you call your product a win-win tender, because the merchant saves interchange, payment costs. They then take a portion of that, so that's their win. They take a portion of their win, pass it on to the consumer as an incentive. Consumer wins by increased incentives, and then that turns into potentially higher top-end revenue for the merchant. So maybe it's a win-win-win, not just a win-win. Anyway,
yeah, you're almost doing my job for me, Dean. I love it. But the bottom line is there is one other thing that's a thread through both that relationship, and it's loyalty. Right? That's the third, maybe it's the fourth win. I don't know, but there is a loyalty play, and I'm telling you, consumers want to be loyal, and merchants want loyalty. So that's the final piece when you've added up all the other things that are actually, financially a win.
Gotcha. That makes all the sense in the world. So, like all things in payments, there has to be complexities. What would you say the biggest consumer barrier is at this time, and how does Pay with Spire address that barrier?
Yeah, I think the familiarity is actually one of the barriers. And what I mean by that is that up until 2 years ago, when we made an addition to our platform, which I'll talk about in a moment, the only way you could make a transaction at the point of sale was through a mobile app. And to be honest with you, we knew early on that most consumers didn't want to pay that way. It's cumbersome. It's clumsy. It's not the way they're used to paying. Look, Dean, they're now used to tapping to pay, not going into an app and rifling through their phone to find, right? They're just not right. Okay. So that was the major barrier. Now, the incentives were sometimes great enough where the consumer would still adopt, but the barrier was still there. And so what we did was we thought, how do we actually go to the consumer with multiple ways to pay, the ways they're used to? How do we cardify pay by bank? And the solution we came up with was a partnership with actually a network provider, with Discover. And so we ride their network rails for the transaction acceptance, and we actually settle through their 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 credit card rails. So for the merchant, they actually have a far easier way to implement the program. And for the consumer, they've got multiple ways to pay. They can still pay in an app, but they can get a physical card, a chip and pin EMV card, or they can then now have that provisioned in their mobile wallet and tap to pay. It's the first time Pay by Bank has been that ubiquitous from a acceptance perspective. And that's now starting to show signs of incredible adoption rate increases, because that's the way consumers want to pay.
All the sense in the world. So as I think about how you've overcome some of the points of friction, how do you balance that with keeping the transaction both secure and compliant?
Yeah, it's always at the forefront of what I think is any payment tender. You've got to keep it secure because the consumer's got to trust it. And so what we do is, going back to the relationship we've created with Discover, once we actually credentialize, and that means once somebody links their bank account to our platform, and we do that through open banking, which now all through OAuth. So you've got to log on through your bank account, and through your bank, the bank actually does the transfer of those credentials. So that's a secure and the most secure way that open banking's ever been. At that point, what we do is we issue that consumer a 16-digit tokenized PAN. And then we never show all 16 digits of that PAN to anybody. It's always wrapped in that token. Now, when it becomes a physical card, we actually only need to show the last four, and that's for provisioning purposes. So when someone's challenged for provisioning in the wallet, you need the last four of the actual card number. We don't show all 16. And so it's always the full 16 digits is always credentialized in a token. And that token has two keys to unlock it: the acquirer and us. And so the merchant never sees the PAN either. The consumer never sees the PAN. So it is literally as secure as if you were using Apple Pay, because it's the same process of tokenizing the PAN, having two keys to unlock it, and never exposing the PAN and the credentials to the merchant or to anybody else for that purpose. And so that for us was one of the things that continued the security element of Pay by Bank, even though we've made it far more ubiquitous.
Again, I mean, it sounds like another win for merchants from a PCI compliance perspective. If they never see the actual PAN, there's no possible data breach, right? So
that's correct. That's correct. Yeah. And we still follow all the NACHA rules, the NACHA codes, because remember, the source of funds is an ACH debit. Even though we ride the rails, we're still using the source of funds as a pay-by-bank transaction. So we also help the merchant stay compliant because we follow all of those rules and the regulations around ACH debits in the first place.
Gotcha. And let's see. So Matt asked, is your offering white labeled so the consumer sees the brand they know?
Yes, that's exactly the way we go to market today. So like I talked about QT Pay, right? That's our product. It's being used by QT, but it's branded by QT. It's a perfect example. And we brand the payment tender in every existing merchant that we have in market. To be honest with you, it's one of the big selling points. Think of it as a PLCC, but it's for a debit, product. That's the way I think that most merchants are now looking at this, even though the unit economics are pay by bank with zero interchange. So we don't even have the debit, burden from an interchange perspective.
Okay. Last two questions, and we're going to open it up for the participants to quiz us. what needs to happen next for Pay with Spire to become a mainstream tender?
Well, I think that we're starting to see merchant acquirers and merchant services companies actually communicate the value of Pay by Bank with merchants so that we don't have to always be the ones doing it. And
Gotcha.
because this is one of the key things that was, I think, maybe a bonus by going with the Discover network. The merchant acquirer is not taken out of the loop. They're firmly in the loop. Now, when I was doing A to A, when the company was doing direct A to A, we didn't need an acquirer. I was just putting the money into the merchant's bank account. To ride the rails and get all the benefits of the rails, you have to have an acquirer on the other side. And so they are now part of the selling process because they always are looking to add value to the merchant stack, and they don't lose out of our version of Pay by Bank. And so we're already seeing that move through the market. That's on the merchant side of things. On the consumer side of things, we see within our database of consumers, by the way, it grew 55% for the first half of this year already. I would say a big part of that is the growing burden on gas prices and just grocery prices. As the price of all the things we buy every day goes up, people are looking for more ways to save. But regardless, it's been a huge increase in our footprint. What we're seeing is so many of those consumers are now using the payment tender at more than one of our merchants. So they're already familiar with Pay by Bank and they're adopting it more and more every single day. And so we've got to continue to do that. Awareness, awareness, awareness at the consumer level is really the way to get them to adopt the alternate payment type.
Great. Last question. If there was one misconception about Pay by Bank that you'd want to correct, what would that be?
I think on the merchant side, it's really the complexity of the implementation. It used to be complex. There was no doubt about it. Think about it with one data point. We were putting money in a bank account out of the consumer's bank account for a purchase that took place at some point of sale somewhere. The merchant had the responsibility of reconciling that. Today, it's reconciled by their acquirer through the Discover file. That is an incredible reduction in complexity. So for the merchant, it's far less complex to do an implementation than ever before. And for the consumer, it's so much more secure. The bank credentials, the way they actually auth the credentials in the first place, they need to know that this is a very, very safe way to pay. It's safer than using their debit card at the same location to make the same purchase.
Sure. Makes sense. Makes sense. Thanks. All right. So we have 6 minutes left. So participants, I see we still have several of them on the call. What questions do you have? Please put them in the chat and we will address them.
Well, I always have a question, but we'll see if anyone else has one.
I would be very surprised if you didn't have a question, David.
Yeah, we know each other for a long time. So there's a few ways here. In each case, well, first of all, Nagendra's point about where it's invoice-based payment, I think is fantastic, but I hadn't even thought of that before. So does that mean you don't see a future in other sorts of payments for surcharging? Or if not, why not? What is it? Is it a communication? Is it getting over consumer resistance to paying extra, or what?
Yeah, I think we are seeing surcharging happening in person. Like as we noted at restaurants, in your doctor's office, dentist's office, things like that. So that is happening. But online e-commerce surcharging, like e-commerce types, it feels like a hard thing. And I think David, it's really driven by competition. So as an example, we think about it as what we call how elastic is the product. So like if I'm going to buy a white t-shirt and I go, to a specialty store to go buy it online, and they're going to present a surcharge to me, I might just hop over to Amazon where I'm not going to get a surcharge to be able
Yeah,
to buy the same
it's
commodity
a click
product.
away.
Exactly. There's not a lot of friction. But on invoice-based payments, or specialty goods, we have a customer who does services like luxury trips, right? To like Antarctica and things like that. You can't really get that anywhere else. Or I'm not gonna not buy the trip because of the payment method, because I also have other payment methods I could choose from. And that's where surcharging is working relatively well and where the adoption is really growing.
Do you see a big storm coming with like, you can put a lot of rules in place. You can pass laws, but if you don't have enforcement, it really doesn't mean that much. And I put a point in there earlier that I think my suspicion is, I can't be sure of it. A lot of ISOs and agents are out there pushing it as a way to pushing non-compliant surcharging as a way to protect their margins and keep the merchant happy. Do you see any point that will become untenable, that there'll be enough enforcement that it'll come down on them? Or is it still going to be like, yeah, I can jaywalk, no one's going to stop me?
There's a lot of enforcement that's already happening
Is
in a
it
pretty big way.
pushing
Yeah,
down through the acquire?
pushing down through the acquirer. And in general, the card networks are starting to move more of their enforcement to the acquirer. So while they do have, I think the number, they have over 100,000 secret shoppers that are out there, and taking in complaints that are coming to their website. Like you can file a complaint with Visa or MasterCard around non-compliant surcharging. But they have people out there who are getting it. And then the other thing the card networks have, at least Visa has done, and we think MasterCard is going to start doing this later this year, is requiring you to incorporate the surcharge amount into the transaction data that is submitted to them. So they know when a surcharge is happening. And so what they're doing is they're saying, hey, acquirers, you got to make sure this is happening. If you don't ensure that we know of the surcharge in the transaction, there's going to be fines for you and or the merchant or the platform who's
They're going to get a lot of pushback. That's a tech list on part of the acquirers and the POS providers. But
yeah,
anyway,
Visa hired they have a whole, I think the number is like they have like 3 dozen people, like white collar workers dedicated to enforcement, and it rolls up to the global head of acquiring at Visa.
and jumping over to Matt for a second, if I may, because we're going to break out in a minute. It may just be us, but we'll see how many people are there. Um, where are the biggest? So gas sounds fun. I mean, that completely makes sense to me, and that they've always been a narrow margin business, and so on and so forth. And if you can say, as you said, in the time of inflation, you're paying more per gallon of gas. If you can say 2 to 3%, what other verticals do you think are ripe for this?
Grocery, where loyalty really is a part of almost every transaction within loyalty. I think we see upwards of 80% of grocery transactions, your phone number is punched into the pin pad. Huge opportunity for those regular shoppers to get a small discount on a regular basis, for the tender choice that the grocery store wants. Convenience, I know that everybody sells gas. Let's just park gas as being branded fuel for a second. In the convenience space, and by the way, convenience stores in the United States right now are literally growing so fast. The Casey's of the world, the Quick Trips, the Wawas, the Bucky's, like it's back, right? Convenience is back. It's hot again because they've all gone with one specialty, either food or beverage, that's drawing people into the convenience store. They may fill up for gas, but that's just an add-on. Convenience is very, very ripe for this. And then I would say the other one is coffee, the one legal vice that we can have every day. And I believe that the top up for coffee is probably the most ripe for this particular type of payment tender. You put $25 onto a payment card, you've eliminated all the interchange for all the transactions based on the $25, and then you went zero interchange for the $25 in the first place. And so for they're the ones that I think are the most relevant. And what I would suggest, David, is I would bucket those as everyday spend. And everyday
And that's
spend
going to be
is
an
where,
interesting one because I see a lot of surcharging at coffee anyway. And so there's surcharging there. Also putting in, I mean, you could do it, but a lot of those shops depend on Square or someone else is doing it. So that would seem to me to be an entry point if you could get in, if you could, I don't know, I'm sure you thought about this, but if they're already surcharging, are they going to want up and pay by bank too?
well, I think that, look, there's a long tail of merchants, and that long tail of merchants will be getting benefit from, like you said, usually the point of sale provider. And the point of sale provider can actually take pay by bank and offer it to all the merchants under the umbrella of that actual point of sale. For example, Square Pay is a great example, right? They already have a method to actually put money onto a payment type. You can use it through the Square portfolio. And if you were able to top that up with pay by bank, which is the method that they're pursuing, that's the win. I don't know if you've been taking an Uber ride recently. They constantly are asking you to use pay by bank in the Uber app, about to be in the Lyft app. DoorDash, very interested in pay by bank. And so the e-commerce, everyday spend, people that are already using debit are a great opportunity. In the convenience store space, 60 to 65% of all transactions now are debit transactions. So they're ripe for an alternate payment type that's debit in the way it takes the money out of your bank account, but you're going to get rewarded for it. Actually, we coined a little term, which is debit with benefits. And that's kind of what we see as the alternate payment type that pay by bank can be.
Yeah, David, one thing I'll just add there to what Matt said is when you're surcharging, again, the big thing is customer choice and having multiple payment options. And so having a pay by bank solution alongside surcharging is really, really and probably invaluable. For our B2B merchants, having an ACH option is critical alongside implementing surcharging. Because again, you're not surcharging every transaction. Like you're not surcharging 100% of your payments.
Right.
And what you're typically trying to do is shift some of those people over to the no interchange offering. And Pay by Bank is just really complementary of that.
So, with my NYPAY hat on, Bill, do you want to split out or is it just a few small group? We should keep talking.
Yeah, I would say just keep talking.
Okay, so we can keep talking for a little while. And Rod, are you still there? Rod, you always have a question. This is Rod Reed from Always Been a
Yes,
Person.
I'm here.
Yeah, you got anything? You always have something to say.
Yeah, what I found, I mean, all the discussion was interesting. The conversation about the settlement was mind-opening, and particularly about buying groups. That's I guess I'm wondering if any of the merchants have tentatively gotten together to form or use a buying group.
It's a funny thing. There are people out there in the early stages, at least, of buying groups, and the amount of non-disclosure requirements to even talk about it is pretty impressive. So yes, it's happening, but it's happening in a very stealth mode. There's folks who are waiting to see what happens with the settlement. There are folks who are waiting to see, how quickly they can kind of assemble the groups. One interesting aspect of it is that the Visa and MasterCard, in the proposed settlement, Visa and MasterCard require that merchant buying groups be nonprofits. There's a legal point of view that says even if the settlement passes as is, they don't have any right to require that. So there's a lot of the legal ancillary issues that need to be figured out. But I think that over the next year, you'll start to see folks making announcements on the subject.
it's very interesting because you can see uh, terminal providers as well as merchant processors forming their own buying groups as a competitive way to differentiate themselves. And so they can sell their services and sell the buying group at the same time, and therefore offer a lower interchange.
Yes. And some of that will then play into that question of, gee, if it's a processor driven buying group, is it not, is it a nonprofit? And I think that's where Visa and MasterCard have developed that approach to constraining existing players in the ecosystem from just jumping in. But we'll see if that holds, because again, there's this legal opinion that says, settlement or not, Visa and MasterCard can't enforce that rule. So that'll be interesting to see how that plays out. There's also the question of merchant skepticism that incumbent players in the payments ecosystem are looking out for them. A lot of the folks already serving merchants feel like, gosh, when you get a processor statement, it's indecipherable. And so they're skeptical that the folks giving them such a complicated statement are going to be truly looking out for them. So that's kind of saying that the incumbent players in this space, they'll have to manage their reputation very closely to make sure that they can tell merchants in good faith, yeah, I'm looking out for you here.
Yeah, I can see a situation where a major acquiring bank could do the same thing.
You got it.
For sure.
Yeah.
Well, what that brings up to me, though, is, and I was thinking of what Matt was talking about a minute ago, is that if you've got an acquirer doing this for you, what's the economic model? Because did they just mark up the pay by bank ACH fee, or where do they make money?
You're talking about the acquirer?
Yeah, I'm asking Matt.
Yeah.
Yeah, their fee to the merchant is on a transaction by transaction basis, and our transactions are just part of that pool. And so they provide the service of settlement, reconciliation, and that is a transaction by transaction fee.
Essentially, it's like in merchant discount, you've got a small portion of that 5, 6, 8% that is the acquirer's piece, and the acquirer just says, "Hi, there's the buy rate for the ACH that they're getting from you, and then they're marking it up just as they would with interchange."
No, because we sell the pay by bank to the merchant, and the transactions cost on our side of things. What normally happens, the acquirer is charging on the other side for this is provided with for the communication of the transaction, obviously between the network and the actual merchant themselves. And because we use the network, so just like credit card or debit transactions, the way in which the merchant actually is getting charged by the acquirer.
Does Discover add assessment on it like Visa and MasterCard would on something that flows through their network?
You mean from
so a
merchant's
merchant pays
perspective?
Yeah, from the merchant perspective, they're going to pay interchange. They're going to pay whatever the acquirer marks it up by, and they're going to pay the assessments and everything from the networks. So if they're using pay by bank from Discover network, what do they pay? What are the pieces of it that the merchant pays? Their total discount rate.
Yeah, so it's zero interchange. They'll pay a transaction fee to Spire. They'll have the acquirer, whatever they charge for, like you said, the markup. And then if there's a network fee to Discover, then they'll still be responsible for that too. In most cases, the merchant has usually created a relationship with Discover that makes that fee relatively small or zero.
Okay. Well, I'm getting very geeky here. So the last thing I'd love to just ask, and obviously anyone else chime in, but I'm a payment geek. Everyone's talking about agentic commerce. Now, I'm skeptical about how long it will take for that to go anywhere and catch on. But if you do have an agent that is then choosing to buy, my top of the line thinking was that can make it easier to route the transaction. Have the agent, based on whatever kind of criteria you put in there, choose a particular type of payment tender. So have you guys? I'm sure you're thinking about it. How have you guys thought about that?
Yeah, I know that from the wallet perspective, Google and Apple, I know they're adding agentic capabilities to their wallet. So if you've got a particular payment tender in the wallet, they're going to be looking at, based on the criteria you talked about, David, looking at presenting top of wallet the best choice for the consumer for any given transaction. And so that's a situation where it could be the best rewards, it could be the best discount, it could be based on the fact that you're in the store, that you've got a card for that store, all sorts of things like that. But I do know that that's the path of the way the wallets are going to be implementing agentic commerce to the way in which consumers then use the wallet for the ultimate transaction.
And
Lee,
the general,
I saw that you had your hand raised.
Yeah. So I'm just listening. This is a great discussion, and I'm very appreciative. But I'm trying to see big picture. How's this going to play out? So buying groups, gosh, you don't have to do much, and you start getting a discount because you're just merging your volume. And it's like as long as somebody's smart at doing that, the small merchants do better. But, interchange doesn't go away, but it keeps going down. Surcharging, if everybody could do it, well, then the problem's done because you're all trying to address the cost to the merchant of interchange. I don't think that happens right away, but it happens in more and more sectors or markets, right? And we kind of have to decide how that works. And then the loyalty slash pay by bank piece is bolting loyalty onto it because you got to provide the customer something. Of course, supermarkets have loyalty programs without bolting on pay by bank. Some do, some don't. So that has kind of a standalone option, right? I can do loyalty programs, or it has a pay by bank plus. How is this going to play out? I'm just wondering how you all think. Does one take hold? Do we do them all? What do you think?
Well, I think from what we're seeing in the penetration rate for pay by bank at a merchant that we've got in our portfolio, we see penetration rates being between 2 and 6% in kind of early stage. In other words, the first 12 to 18 months that the payment tender is in the market. So we don't go in thinking we are going to be everything to everybody. But as Lou said early on, 2 to 5%, 2 to 6% is meaningful. I could give you incredible savings that we've been given to big merchants. Obviously, at the moment, we work very closely with the whales. They're saving tens, if not hundreds of millions of dollars by just moving 5% over to a zero interchange product. And they use that, like we talked about, to go and incent the consumer, which effectively means that the payment tender is paying for their rewards program, which is, that's very valuable. But we're not saying that we can go in and say, well, everybody's going to use this payment tender. It's not going to be the case. So our realistic approach is to start to 2%, get to 5% in the first 18 months. And the ultimate goal of almost every merchant I speak to, they'd like to hover around 10 in the long run.
One of the things, absolutely agree, Matt, and believing that, if you look, just say 3 years out, and maybe sooner, maybe 4 years or 5, but, at some point, I think you'll see merchants deploying all of these tools. Not every merchant in every category is going to have all of these tools, but I think that it will start to sort itself out where merchants will have a quiver, if you will, of tools that they have only had starting in the last few years, that they'll overcome these early adoption issues, and that ability to influence 5, 10, or even 15% of their consumer volume just gives them tremendous leverage to start working their payments costs down, and that the networks and other players in the ecosystem, I think, will respect that immensely.
I have nothing to add. I think it's going to be part of a portfolio of options, and that's how we see surcharging being used today as one portfolio or one tool in the portfolio of options.
Right. So none of the three are going to claim victory in a few years, right? So,
I think
No.
you need all the tools.
But it does set up a very interesting, call it 3 years, a very interesting 3 years ahead between, again, if the settlement stalls, these things are happening anyway. The settlement is a tailwind to these things. It allows much liberalized surcharging. It will incentivize pay by bank. It endorses buying groups. So the next 3 years, it's kind of, buckle up if you're in the payments industry, because I do think that 3 years from now, we will see that 236 basis point average for Visa and MasterCard. Now, if the settlement goes through, they're obligated to bring that down by 10 basis points. But so whatever you're, with a settlement or without a settlement, it will go down a substantial amount just based on these industry dynamics that are happening independently.
And having been a card guy I was at American Express a long time ago. I just see the rewards value losing some of its grip. There's an aspirational value. What can I do? But the airlines and everyone's making it harder to redeem. And if I couldn't get the tickets I get with my Chase Sapphire, it costs too much card, I'd drop it because it's not worth it. And in fact,
that's an argument in favor of these tools.
Yes. No, exactly. That's the point
exactly.
I'm making, is that they're devaluing over time because the economics are getting too hard to support. But we'll see. But that's just my observation.
And when you look at the merchants, and I've had this conversation with a few, merchants in some ways have been too intimidated by the issuing banks' rewards programs. Because at the end of the day, an issuing bank has to pay for their rewards out of interchange. And so they're accumulating.
Not completely. If you got a lot of revolvers, you're going to get some of the money from revolvers. But interchange is a big part.
No, but the fair point. But a merchant has more
that's
margin.
The annual fees now $800 a year. Thank you, Rod.
Merchants have more margin to play with than the issuing banks, at least in terms of the transaction.
Yes.
If you start throwing finance charges into it, we'll see. But if you're let's look at coffee, right? If you can incentivize your customers with a loyalty program for which the primary benefit is coffee, which is what's the margin on coffee? Starbucks shows us that day in and day out. You have more margin to play with than the banks.
Yeah, and I think to add to that, Lou, the merchants want to incent through rewards directly to the consumer. They're sick of going through these big pools of redeemable rewards, because you forget that you bought gas at Chevron when you go to Mexico, right?
Exactly.
And they're fed up with it. And so they're much more incented to say, I'm going to give you 25 cents off a gallon if you just use this payment tender than if you use this other one, even though I know I'm going to have to pay for the rewards in some other way. So I do agree 100% with that. And here's the last thing I'll say on this topic is the US consumer is running out of credit. And so they, by definition, they have to look at alternate payment types. They're not getting another credit card. They're not getting an extension of their limit.
They're going to file for bankruptcy. And they're gambling on all the on FanDuel. So yeah, they're going to file pretty
soon. But that's why trends have gone to using debit as the biggest form of payment in everyday spend, because they've run out of credit. And this is happening pretty fast. So look, alternate payments are definitely, as Lou said, I think it's really, the next 3 years are really going to surface all of these ways that the merchant can get a better deal.
Mm-hmm.
So I have a quick question for Dean and maybe for Matt. Historically, when I've heard the term pay by bank, that term to me and what I've seen, once in a while, is the merchant somehow asking for your online bank credentials. I assume that they're accessing your online bank and paying the merchant directly. How does that jive with what Matt has said about pay by bank using essentially the ACH?
Well, all right. So,
To get
so, so
paid.
pay, yeah. So pay by bank is an ACH transaction, right? It's
Right,
just the distinction for Pay with Spire is the rails over which it rides. I would also, and the familiarity with the process with the transaction. So I take out this card. I'm super familiar with cards, and I'm going to tap it, swipe it, dip it, whatever. And that money is going to come out of my debit account, just as
right,
if I had out of my DDA account, just as if I had used my debit card, right? Except I'm not paying debit interchange. I'm paying ACH fees, which are a tiny, tiny, tiny fraction of a debit card interchange transaction. To replay what Matt said about security, no, the merchant is not asking for the customer's bank credentials. The consumer is logging on to their bank, and the bank is providing not the merchant, but Pay with Spire, the necessary credentials to create that connection between the card that rides on the Discover rails and the consumer's DDA account. Matt, I hope I got that right, but feel free to correct anything I got wrong.
You're spot on, Dean. You're spot on. The merchant is not getting any credentials, not even the pan at the point of sale. They're getting no credentials. We're getting the credentials. And those credentials are shared with us securely by the consumer's bank. So it's direct, authorized exchange of those credentials. They expire, so they have to re-credentialize in certain circumstances with certain banks. Open banking has come, as I said before, an enormous way in the way in which it secures that exchange. Um, we only accept OAuth as a means of exchanging those credentials now, and it's really the way in which most of the industry is going. But you could spot on. The flow that you just used, Dean, is exactly the flow that is in place today with the Pay with Spire product.
Good. But
Are
one of
there,
the other things I'd love to echo and amplify, and Rob, sorry, I didn't mean to cut you off, but we mentioned rewards and the merchant's relationship to credit card rewards today. So my background is as a merchant for 30 plus years, and nothing made me angrier than to know that David is taking his trip to Hawaii, which has nothing to do with me as a merchant, but that I or my consumers paid for David's trip. It is a very, very different scenario if the consumer receives a reward to get a free lunch in my store, or to get a free shirt in my store, or to get a whatever, a gift certificate, a gift card, or whatever that is branded as me. The consumer knows that I gave them that reward. And oh, by the way, it creates an additional opportunity, sales opportunity with that consumer as well. That just doesn't happen in today's system where, David gets to go to Hawaii because he purchased a whole bunch of socks and shoes and underwear at my store.
But you can see the great value to me of that because so
Oh,
anyway,
sure.
we got a lot of things to work out. It's a fun. We've got a bunch of payment geeks on here. I want to thank everybody. I want to specifically thank Agenda and for sponsoring this event. And we wouldn't have had this with Interpayments without his generous support. NYPAY does stuff all the time. You can find the videos of pretty much everything for the last 5 years on YouTube NYPAY. This should be posted within a week and a half, 2 weeks. We'll send a note out to you so you can grab it and slice it and dice it and do what you will with it. But I mean, I love this stuff. It's just fascinating. The whole reason I got close to folks like merchants was when Durbin came out. I wrote something in American Banker about it, about how, don't get your knickers in a twist. It could be a good thing. Anyway, this touches on economics. It touches on consumer preference. It touches on all sorts of things. So it's really fun to watch. It would be part of. So thank you, everyone, for the good questions, for the great comments. And, we can walk away thinking about things differently than we did when we came into this conversation, I hope.